Hi everyone, welcome to my channel. So today we'll be talking about a very nice trade. Best part about this trade is that it has a probability of profit of 90%. So this is a strategy which many of the hedge funds use since because of the high probability of profit, and also because of very little adjustments and very little stop losses are required in this trade. So this trade will require a margin of $500. So you can trade this on Deribit, or you can trade it on the Delta exchange itself. Okay. So this strategy has a high probability of profit, and along with that, it has a very high maximum profit probability also. So the maximum profit which you can make is $360, and the maximum loss this strategy will attain is $60. So the maximum profit is plus 72%, maximum loss is minus 12%, and the probability of profit is 90%. So that is the main reason why I like this trade. So I'll have ChatGPT explain this trade to you. So I just asked ChatGPT to generate a description of this trade. So this trade is basically a call ratio spread with a 1:2, which involves buying a long call option at a lower strike price and selling two call option at a higher strike price, as you can see. So basically what we'll be doing is we'll be buying one long call option at the 1600 strike price, and we'll be selling the two short call options at the 2000 strike price. This is in Ethereum, and the expiry we'll be choosing is the 26th May expiry. Why the 26th May expiry? So basically I like trading in the 45 to 90-day expiry. So having a longer time to expiry, having more days to expiry makes the trade more safer, helps you collect more premium, and also gives you a better probability of profit. Okay. So let's go back to ChatGPT. So ChatGPT explains that the idea behind this strategy to buy one 1600 call option and sell two 2000 call options is to take advantage of the price difference between the two strike prices, so that is 1600 and 2000, while minimizing the risk, which we talked about earlier. The long call option will give the investor the right to purchase the underlying asset, in this case Ethereum, at a lower strike price. If the price of Ethereum rises above 1600, the investor can exercise the call option and profit from the difference between the strike price and the market price. So what this means is that if you have a long 1600 call option, Ethereum is currently trading at 1600. If Ethereum, let's say, goes to 1800, you will still have the right to buy Ethereum no matter what the price is. The price may be 1800, 1900, or whatever. You can still buy Ethereum at a price of 1600, which is the main part of this strategy. And why do we have the two short call options? So the short call options are sold at a higher strike price, which will reduce the cost of buying the long call option. So basically, if you were to buy a long call option of Ethereum at the 1600 strike price, you will have to pay $180, as you can see here. So you'll have to pay $180. So your maximum loss will be $180. But if you sell the two call options, your maximum loss, the maximum premium which you have paid, goes down. So that is why we are trying to reduce the cost of the long call option. Also, this strategy is perfect for people who do not wish to look at charts a lot, who have a working job, or do not have much time to devote to trading. And also in this strategy, I won't be looking at the chart also. Okay. So that is what we are going to do. And I have also created a calculator for this. So if you see the Ethereum's 1600 call option is priced as 180.88, and the 2000 call option is priced at 58.12. So if I just enter these prices here, 180.88, and I think it was 60, it's 58.12. 58.12. Okay, so if you input these premiums of these options, you can get this chart. So if I just expand this chart for you, you can see that if Ethereum goes down from our current strike price, the maximum loss which we can get is 64.56, which I mentioned in the doc. But the prices of option have changed while I was shooting the video. So if you're seeing this video at a later time, the prices may change further. Also, you can see that the maximum profit at the range of 2000 is 335. So what we expect is we expect Ethereum to stay in this range. So I don't expect Ethereum to go above $2000 in 90 days. And no matter if it goes to $100, $300, $500, or even if to $0, the maximum loss this strategy can take is only $64, which is the best part about this strategy. Okay, so this is the trade which we are going to take. And if you look at the upside, so basically it is going negative at the price of above $2,400. So to see the probability of profit of this trade, so you can just look at the delta of the option. So delta is a risk measure which gives you what the probability of the option going above the strike price. So if you see that the 2400 call option and the 2500 call option have a delta of 0.11 and 0.90. So this says that Ethereum has a probability of 11% of going above 2400 and a 9% probability only of going above 2500. So I averaged these two to get a number of 10%. Also, for people who do not like this $64 downside loss, another thing which you can do is, I've asked ChatGPT to explain it also. So what you can do, which I've mentioned in the strategy also, is that you can add a call calendar. So as ChatGPT explains it, so to further enhance the potential profit of a call ratio spread, our earlier strategy, what we can do is that we can add a call calendar to it. Okay. So what is a call calendar? A call calendar involves buying a call option with a longer expiration date, in this case the 26th May expiry, and selling a call option with a shorter expiration date, which will be our weekly option. So in this case, we'll be buying a LOL call option at the price of 1600 in the 26th May expiry, and we'll be selling some short call options, weekly call options. So basically, you can sell the 1700 call option of the weekly expiry, which is going to expire in 4 days. So on each week, you can collect a premium of roughly $8, $10, or $5 sometimes, depending upon the implied volatility of Ethereum that week. So if I just input these prices here, so if I input 8.82, and since it's 90-day, you will get 12 weeks. So 90 divided by 12 will give you 12, 90 divided by 7 will give you 12 weeks. So you can see that the since we've added this call calendar also, the downside max loss now changes to a downside profit. So now the downside profit is $41. So even if Ethereum goes down, you're still going to make $41. Our maximum loss is the case in which Ethereum goes above 2500, and as we can see that that is only a 9% probability. Also, you can keep on selling the OTM call options till Ethereum goes up. And after Ethereum goes up, you can convert this call calendar into a call put calendar, and you can sell OTM put options, 100 points away put options, for a similar $8 or $10 premium. So this is a strategy in which anyone can very easily make money with very low amount of management required, and this is a very safe strategy with a high probability of profit, which is why we choose this strategy. So I'll be taking this strategy with a capital of $1,000, and I'll keep updating you weekly. If you have any questions about the strategy, you can mention them in the comments below. Thank you so much.